All right, so we're got the test complete. For most of you, there's still a couple stragglers with some computer issues, but we'll get through that. Everybody else, though, good job, and we'll continue on. Today, we're going to be talking about life insurance. So, life insurance is something that's pretty important. It's not so important for you, obviously, because in order to collect on it, you have to have passed, but you can really leave a mess for your beneficiaries. So, plus, there's a lot of sort of whatever opinions, wisdom, judgments that need to be made. It's not a certainly not a one size fits all, and it depends what you're comfortable with. So, let's look at some of the details on it. So, life insurance. So, yeah, payment to a beneficiary. The beneficiary is the person who's going to be beyond, or a group of people, whatever. Perhaps a family, perhaps somebody else, perhaps even a charity, whoever, but somebody. And it's you know not a bad thing to not die penniless. Obviously, you don't want to be a miser. You can't take it with you, as you know. But other people are definitely going to be affected, and you want your passing to be focused on you, very selfishly, and not on, oh my God, how are we even going to get this dude buried? So anyway, we'll go through it. So financials, yeah, leave money for heirs, and it's only fair. I mean, depending on how you have your life structured, especially if you are, in this classical breadwinner scenario, whether it's you or your spouse, and the other one's taking care of other issues while you're off earning the money, and to leave people and your children hanging is something that's completely avoidable. So anyway, well, not completely, but mostly. Yeah, people don't like to talk about it, but whatever. You need to deal with it now, or they will talk about it later, and not in a good way. You'll be judged. Role of the insurance company. So the insurance companies, they have the deep pockets that can help you through this, and I don't know, it's an evil corporation helping you. Well, anyway, they can make this process better. So applying for life insurance, yep. This is where it gets a little dangerous in terms of medical information, lifestyle, the rest of it. They want to know as much about you as possible, things you don't want them to know. So you can't necessarily hide things from them, nor do you want to. But if they could get access, and I've mentioned this before, your DNA or other things going on, they would definitely want that to make the most of the situation, and either not insure you or jack up your rates. So, term insurance. I'll talk more about term insurance later on, but that's what I'm a big proponent of. So don't feel that, oh man, I need to spend all kinds of money. You can. There's people out there who are more than willing to set you up in that type of program. Or you can look at life insurance for what it is. And the big picture here is on life insurance. I think the healthy way to look at it, and the way I believe smarter people look at it, is that it's for a certain length of time. It's not for your entire life. And, contrary to what the name says, there's a certain time in your life where your beneficiaries, the people depending on you, are very vulnerable, because you're just kind of getting started, yet you've probably bought a house, hopefully. You've got children that are, maybe not, they're still children. They've got their whole life ahead of you. They've got a dependence on you. There's a bit of a contract when you went down this road that you were going to take care of these kids for a certain length of time. And if you check out, through no fault of their own, they're kind of screwed. But there's ways to take care of that. Well, these needs in terms of insurance are incredibly high when you're in your young, earning years, where you've got maximum debt, but maximum commitments as well. You've got this house that's unpaid. You've got college educations. You've got perhaps a spouse out there that's going to have to join the workforce again, or do something else or cover for the lack of this year salary that's probably going to be gone, will be gone. Anyway, if you've got a term policy, what they talk about with term, fortunately it's quite easy to understand. Term means that you pay for a certain term, and if you die within that term, they pay you X amount of money. So let's say you're 30 years old and you say, I've done some calculations here, and it's would really help out the family if there was $1 million for them to pay off the house, to make sure we're all debt free, put some money aside for investments. And so, yeah, I've done some research and I've decided $1 million is the number. It can be whatever number, and you will do that hopefully as part of your term projects. Not that difficult, but it's completely dependent on the beneficiaries. If you're a single person and you don't have life insurance, giddy up. You are fine. Who cares? You're not. You don't need it. But if you have people dependent upon me, you need it, and you need it when you're younger. So you need that $1 million. And the good news is that you're young, and you're not bulletproof, but your chances of dying, other than through foolishness, is quite. You're a great insurance risk. So they can give you $1 million coverage for, let's say $50 a month, just pulling a number out. As you get older, that number's going to go higher. Your lifetime warranty is not so good anymore. You should not be considering full life memberships at this point, because they're getting a better deal, because if you're 60 or something like that, you're not per se old, but you're getting closer, and that same insurance policy for $1 million may be, I don't know, maybe $1,000 a month or something. It's now it's getting kind of stupid. But the news, you're 60. Your children, unless you're like Mick Jagger or somebody, your children are hopefully grown. Your children, they either went to college or they didn't. The house, you had a 30-year mortgage on it that you started when you were maybe 30, and so it's paid off, or the very little is owed on it. So you don't have a whole lot of bills. So you hopefully don't need $1 million in coverage, because you don't have $1 million in debts out there. And oh, by the way, you were, let's say, smart about it, and you've got a bit of a nest egg. You've got some retirement, or not retirement stuff, but it could be, but other assets out there. You're worth $1 million. So, frankly, I don't have life insurance. I don't need life insurance. I'm not wealthy, but I don't have a huge amount of debts out there. And well, screw the debtors. But the if I'm dead, but I'm not leaving beneficiaries hanging, because my children are adults, and all the other stuff. I don't need the insurance, so they can keep their products. I don't need them, so I don't care what the term life insurance costs at this point, because I don't want it. So if you look at it that way, it becomes fairly easy to understand. You do a calculation every couple of years or so, and you say, okay, I've got this much debt out there in terms of a home mortgage. I've got this many years for the children's college. At least they're going to have the opportunity to go funded partially by me, so I need a certain amount for that. If I did pass, if you had a spouse, well, you want a bit of a cushion for them. You want to perhaps, there's an expectation they'll may have to go back to work if they hadn't been working, but perhaps they don't want to. So anyway, you're going to come up with some sort of calculation, but it's not going to be as high as it was when you were younger. And so that's where term life insurance can be pretty good. So I sound like I'm a huge, fanboy for term life insurance, but the other issue about it is term life insurance. There's not a lot of, it's at least not the heavy-handed advertising, because it's simple. You don't need a life insurance salesman. There may be one in the process just to sort of sign off on it, but the whole industry, life insurance industry, is set up to sell you more complex products that are whole life, universal life, that
they need to be part of it because they need to explain it because they're complex products. They're a hybrid investment um, life insurance policy that has a cash value and is part of your retirement savings and is just, in my mind and a lot of people's mind, is maybe a little bit more complex than what you need to be. So if you're a salesman and you're involved in insurance, yeah, my apologies. You probably have, may hate me a little bit by now, but for most people, and I'll show a few videos here later on, or it'll be in your video clips, but term life insurance is the easier choice and certainly cheaper because those complex life insurance policies, yeah, they could start out at $600-800 $1,000 a month when you're younger because you're saving, you're accumulating investments with these people. But the problem is these people are insurance companies. They're not necessarily investment companies, and they're probably a little bit more cautious than you need to be. Anyway, you can look at the data. They don't get the type of returns that regular investment-focused companies get. So it's different model. So that kind of summarizes term life insurance, but we'll continue on here. Determinants, yeah, longer term, higher the premium. So if you want a commitment out of these folks for 20 years, now you're taking this policy when you're, say, 30, the tail end of that policy, you're going to be 50. So, yeah, it's going to be higher because you're getting older. Older goes without saying, greater the amount, higher the premium, fair enough. I mean, all this stuff it's pretty easy to understand. Higher for males and females, yeah. Males, I don't know if they tend to, but lifestyle-wise, and I'm not being sexist here, but I don't know too many female roofers, too many female loggers. There's some out there, but the guys getting killed in the workplace is quite a bit. I mean, especially when it comes to wartime soldiers. That's we're on the brink of World War III. But anyway, yeah. So these guys, it's nothing sexist about it. There's people called actuarials, and they sit there, or actuaries, and they sit there and do the calculations based upon all the information. It's big data, and they calculate sad things about when people are going to die and how good a risk you are, and it's nothing personal. And same with smokers. If you smoke, you've made a choice that I don't think there's disputable that you're going to live a little less longer. Medical problems, they love to have that information. They'd love to know your family history with cancer and other things, but do you want to share it with them? Anyway, one story here. I was it was post Desert Storm. There was another, we were doing a little war skirmish thing, Kosovo and the former Yugoslavia, and I was flying Wild Weasels at the time, getting ready to deploy, and I was in that high threat scenario. I had 2 daughters, and I had a wife who was also military, but anyway, it was in young 30s, and if I would have passed, it would have been a problem. And I'm going off to fight a war, so it's kind of a little high stress situation. So I pursued, I think I had 3 $1 million term life insurance policies that I took out within a week or two. And the insurance companies, even back then, they share data, and they're like, this is strange. This guy obviously knows something's going on, that he must know that his life is being threatened. And they never ever asked about wartime stuff, but they did ask about scuba diving, paragliding, parachuting, all those recreational type things that tend to kill people a little more often. But then they had a lady come out to the house, and she may have been a nurse, maybe not, but anyway, she was wearing a little nurse outfit. It was like Halloween, and she wanted to draw my blood. And again, it was conditional on getting the policy because they were a bit spooked. But anyway, I ended up with all those policies, and we went off to it wasn't much of a war, but anyway,
for what it lasted, and then it came back, and it's term life. I canceled all those policies because now I was back to normal risk, which was still, semi high flying fighters, but whatever. It wasn't like a war, so you can get, those policies quite easily. Even then, it was on the phone or online. No interviews other than the woman coming out to take my blood. Annual premium, yeah, you're not a good risk at this point. So they're showing some premiums in here, and they're kind of ballpark about what I was talking about. I don't know. It's, the good thing too is this is outside of personal finance, but when they talk about, the average life expectancy of a person is maybe high 70s or something like that. If you make it to the high 70s, your life expectancy is actually quite a bit longer. Because when they talk about average life expectancy, they're talking people who, died at birth. They're talking people who, whatever, motorcycle accidents back in their 20s and 30s. And if you don't engage in those lifestyles, if you're not, actively involved in drugs or drug deals and getting shot, you're actually going to be into the 80s. So no reason to stress. Annual premiums, coverage levels, so yeah. Very linear, no magic here. Smokers, non-smokers, yep, female. So anyway, different ways you can keep the policy. When I said it's $50 a month, well, if you start $50 a month when you're 30, they could structure this thing to say, okay, we'll give you $1 million coverage when you're 30, because that makes sense. But as you start getting older, you present a higher risk. If you want to keep that dollar figure, that premium at $50, your coverages start to go down, or they can keep it. Okay, you're going to get your $1 million of coverage throughout the term, but the premium's going to go up. Or we can set this whole thing up in a contract, and we'll charge you more when we'll keep it level, but in essence, you're going to be paying $70 when really the math only shows you to pay. Anyway, a lot of ways to do it. A lot of different companies out there, but it's dead easy. You can do it all online. There's a company, any type of investment type thing, there's usually a third-party company, Moody's, Fitch, Standard & Poor's, that do they evaluate investments, and they usually concentrate on a certain segment. Morningstar does mutual funds. So when you're making decisions like this, you look to one of these third-party rating agencies. In the insurance business, there may be more than one, but AM Best is a company that, they stake their reputation on determining the solvency and whatever. They review these insurance companies. So if you find a cheap rate online with an insurance company and you haven't heard of it, look at their AM Best rating. Maybe you just haven't heard of it, or maybe they're dodgy. So anyway, you look for a third-party rating. Mortgage life insurance, yeah, I think I mentioned this before. This will typically be included as a benefit to you, but in essence, you're paying for it. But it's a good thing. It means when you take out a mortgage with some companies, sometimes in the mortgage contract there'll be a thing, in the event of your death, this mortgage is paid in full. Well, that's kind of nice, and it's good to know about. Again, there's no free lunch. Somebody's paying for it, so you're paying some sort of fee in there. But it makes things much cleaner for the insurance company, for the mortgage company, for your spouse, for whoever on this thing. But don't worry about that. Group term insurance. So anytime they have a group, generally whether it's health insurance, auto insurance, any of that kind of stuff, you want to be in a group because you'll generally find the rates cheaper. So
whole life insurance. So now we're getting into things, and this is where the complexity begins, because number one, whole life insurance to one company means one thing, and permanent life insurance. I mean, these are terms that need to be explained. They're not intuitively obvious, and part of that's intentional. So, and part of it's marketing too. They'll try and change the name. There's a policy that's now out there, variable life insurance, where it means that they can move around a little bit in the market and stuff. Anyway, it's just none of it is all that descriptive, and by law, these policies need to be sold to you by a person associated with that company who's, oh, by the way, on commission, so front-loaded commission and the rest of it. Anyway, what you can do with these, though, is you can achieve like I say, an investment and an insurance policy at the same time, and they do have a cash value. Now, obviously, if you cash the policy out, before you pass, then you're not going to have that life insurance. But anyway, I think if you look at the parameters and the amount of money you spend, you may decide, like I've kind of recommended, that you keep your life insurance separate from your investments, that you perhaps go with term life insurance, and then for investments you do real investments. But anyway, I'm not, the insurance salesperson sitting across of you who can make the case probably pretty compellingly, because they have to do it quite a bit. Whole life insurance, but anyway, yeah, the same sort of factors depending on when you get into life. Forms of whole life insurance. You have all kinds of different options. Comparison to term. So, higher premiums, maybe by a factor of 10, at least. Accumulate savings, so it is an investment, so there is something there. Whole life, they remain constant. So, sometimes that's, important to people. Well, I want to have insurance when I'm 60, when I'm 65, and I know if I went with term life, those payments would be unaffordable. Yes, they would be. So, yeah, in whole life, because you've paid in so much money already, the premiums can remain constant. I would argue that you don't need insurance at that point in your life, but again. Universal life, so again, kind of nebulous terms. Provides insurance over specified term, accumulates savings, and then variable. Yeah, you can invest in some different funds to increase the investment potential. Anyway. So, determining how much you need. There's simple ways, and then there's more complex ways. This is a very simple way. Is it useful? I'd say absolutely not. Income method. So a method determines how much life insurance based upon your income. So you look at your annual income, you multiply it by some factor, and you decide that's your insurance. I mean, in my mind, why bother? I mean, this isn't a calculation. The single person would come up with the same calculation as the married person with 5 kids and multiple mortgages. It's not comprehensive enough. It doesn't take into account the situation. So, budget method, needs method. So, annual living expenses, special future expenses, college, dream, vacation that you've always planned and we're on track to achieve, taking care of the debt, job marketability of the spouse. The spouse, sent you to UAA and postponed their own education. They may want to go back to school so that they can make more money in the second part of their life, but now they can't do that because you're not here. Value of existing savings. So a little bit more comprehensive. So this would work. And so if you're doing your term paper and you're trying to figure out how much life insurance you need, you might come up with your policy. And again, I'm not gonna. If you say I'm gonna do the universal life or whatever, or I've already started on it, that's your choice. And as long as you've thought about it and you've considered it and said, I agree with somebody else's opinion more than whatever, you'll still get a great grade on your term paper. I'm not, using a subjective data like that. Using the internet. Well, the internet's not magic. The internet can be helpful in achieving that needs method. So, and here's some more factors. Yeah, debt level could increase and close. So it's kind of coming right back to the needs, but there's nothing magical about the internet, even if you capitalize it. Life needs calculators, certainly. Don't be shocked, though, when these people try to focus you towards a policy that is perhaps more expensive, perhaps involves commissions, perhaps all the rest of that. Because it's a big business, and you are the product. So, but it might be more comprehensive than some of your needs that you come up with, or some of the things I've mentioned. And everybody's got a special case, but what you don't want to have happen is you have people depending upon you and be, obviously they're going to be emotionally affected. Let's hope, selfishly, fairly drastically emotionally affected, but you don't need them financially affected as well. Needs and dreams. Well, this gets into personal stuff, but preferences for college educations for children. Yeah, I mean, if you're going to get to a certain point where, the kids will either gone or not gone, or perhaps trade school, or perhaps a little boost in life to start them out with enough money for a down payment on a house, so they don't start out, where you did, or maybe you were fortunate to have somebody pass on some money to you. So there's certain things that are certainly affordable in term life insurance when you're young. Later in life, those needs, those sort of dreams should have been taken care of by your savings. You could pass on that legacy rather than an insurance policy that's sort of like winning the lottery because the person passed. That's not good. Beneficiary, we discussed that. That is that person, thing, institution. Grace period, yeah, you got to read the fine print. Sometimes there'll be periods in there, like if you die within the first 2 weeks, they will perhaps not pay because there was something going on there. Living benefits, this is kind of cool and usually a feature of most policies now. Let's say that you have $1 million policy out there, but yet you've got some condition that's going to end up in your certain death, and you're going to continue to fight it and do the medical care, but man, it would be nice to kind of have a little bit of money right now, so in addition to sort of struggling with these medical bills, we could get by, because maybe you're incapacitated, you can't even work at this point because of your illness or whatever, it's some lingering situation. Well, if they're going to pay you $1 million, a year from now when you die, how about, breaking loose with a little bit of that money now, so that we can, get through these final period in with a little bit more grace. So anyway, an option, non-forfeiture. So this has to do with some of these savings type things on a whole life policy, since there's a cash value to it. These you can't take a loan obviously against a term policy, but a whole life policy where there's investment, yeah, you can take a loan against it. Incontestability clauses. So all sorts of cool movies and books, double indemnity and some of these other things, meaning like if you die in an accident, you get more money. If you die via suicide, you get no money. There's clauses and things like that you need to read. Renewability option. It's good to have the option. But again, beyond about 60, you ought to sort of plan. I mean, I'm not saying it's going to happen, but plan your life so as to maybe not need insurance by the time you hit that age, because it's going to be very expensive, and hopefully the insurance payment would not be substantial compared to the amount of wealth you've built up either in a house or something else. So conversion option. Yeah, sometimes they have conversion options to go from term to whole life. And then settlement options. How that money's going to be paid. Lump sum over the course of years. So some fine print in there. So the lump sum installments. Interest payments. Yep. So different methods. Selecting a life insurance company. And there's that AM Best. So you need to, number one, hopefully be a company you've heard of, and then look for a third-party agency who rates the financial solvency. These companies, their business is that they take in money in terms of premiums, and then they pay out money to the beneficiaries. And depending on how good their actuarial actuaries are, rates their solvency. Also, they get this money and they invest it. And if they put it in stupid investments, well, that company's puts that money at risk that probably shouldn't be at risk. That's why life insurance companies have to be a little bit more cautious, because they're saving that money. Whereas investment companies can concentrate more on pure investing because the money's at risk. And, there's a correlation between risk and reward. Hopefully a perfect correlation. If you've got risky investments with no reward, then you're in a scam. But if you've got all reward with very little risk, that doesn't happen. Not very often. You're probably in a Ponzi scheme if you're getting 20% with no risk, and then people are shocked that they're, being ripped off. Well, yeah, that you should have known. So anyway, we'll talk more about that when we get into investments. And there you go, investing fundamentals. So here we are. So this is kind of the meat of the course. We're just going to do kind of an overview. We're going to have a week on mutual funds, a week on stocks, bonds, the rest of it. So I think this stuff's a little bit more interesting. Personal balance sheet, first off, you need to be debt-free of basically whatever, I'll call it stupid debt. Credit cards, if you think you're going to have a credit card balance, you're going to be carrying a monthly balance and starting an investment program, you're fooling yourself. Your investments are not going to match the interest rates that you're paying for that credit card insurance. So you need to get the credit cards paid off. And oh, by the way, even if say you're doing well, I was talking about Bitcoin type stuff. It's up, whatever, since I bought a big chunk a while ago, and it's up about 25%, in 2 months, which is nice. But this is on one of the future ETFs, exchange traded funds, but we'll talk more about that later. But even if I was to sell that right now, it would be sold as a short-term gain, and it would be taxed at, say, 30%. So of that 25%, I only get to keep 70% of that. So anyway, I would still be, even with a screaming return, I'm barely outdoing the credit card interest. You got to get the credit cards paid off, because any money you make is going to be taxed. The money you pay on credit card interest is not even tax deductible. It's just a pure loss. So get the loans taken care of. If it's a home mortgage and it's at a low rate, I'm pretty confident with most investments I can do better than 2-3%, 2.75, whatever the interest rate is on a good mortgage. If you got a 7% mortgage, you need to hopefully refinance as soon as those rates come down. But anyway, So, adequate liquidity, yep. I think after the midterm, everybody understands liquidity pretty well. Money market securities. So, types of investment. Money market securities are really kind of a parking place. Money markets is kind of an all-encompassing term for things like, T-bills and other stuff like that are cash equivalent type things that are generally in government bonds or other type of bonds like that. Government bonds, though, not necessarily commercial bonds. So they're very secure, very little risk, but very little interest. So they're not going to keep up with inflation, not the inflation we've got going at this point. Stocks, on the other hand, stocks are an equity position in a company. You own a chunk of a company. Now, they jump right in with common and preferred stock, which I think is don't worry about it. We're not going to test on what the difference between common and preferred stock is. So, but I'll just cover it here just quickly, just to kind of give you an awareness. If you're involved in a company, companies are making money, right? Corporations, and that money, if it's a company you're investing in, it's a company hopefully that is making money. Maybe it's a startup that's still investing or not making money, but there's potential forward income. Anyway, at a certain point, a company, if it's a good company, will eventually begin making money. When they have that profit, what are they going to do with it? If they're a growing company, they'll probably, because they're trying to grow, they'll roll that money back into the business. So they won't be paying a dividend. Those profits will not be paid. The dividend would be if you got all those profits and you distributed them out to the shareholders. That would be a dividend. If you're a growing company, you're not going to have dividends because you're reinvesting all that money. Now, if you're a larger established company, then you're not growing so fast, and hopefully you're making money, and now you're paying a dividend. So that broad class of companies that are in that category that are paying a dividend, those would be titled income stocks because they're providing some income in, hopefully also additive to that is going to be maybe the share appreciation, where the share goes from $30 to $35, and so you make a little bit of money there. But on an income stock, you should also be getting a quarterly dividend, and that's a little chunk of the profits. Most of these companies are the big companies, the big blue chip companies. So maybe a little safer, maybe a little stable, more stable, well established, but they're not going to have that same stock price growth in most cases. So for the most part, I've never really invested in those types of companies. I've always invested in a lot of companies in the tech sector that are growth companies that never ever paid a dividend. But if we're looking at the stocks that do pay a dividend, those companies, the income stocks, they may have a couple classes of shares. And this is common stocks and preferred stocks. So common are the general stocks that most people have, and then preferred stock is a certain class that in the eventual situation or potential situation where a company is having a little bit of financial trouble or maybe not making much of a profit, the preferred stockholders would get the dividend. If the company's not going to be able to pay a dividend to everybody, they would just pay it to the preferred stockholders, and the common stockholders would not get a dividend. So, again, I think they're getting down to the minutia here because, number one, this is not typically a class of stocks that I even own because I still invest like a college student in terms of young, aggressive companies, probably taking more risk than I should. But, I've got other investments and stuff, so I'm not relying on the stock market for income. So I'm more aggressive. So I never invest in companies or have not invested in companies that do pay a dividend. So I never see this factor. And I should probably start a little bit more in case people are getting confused here between what exactly a stock is. So when a company, corporation, they want to form, they want to grow, they want to establish a business, they need capital, they need money to do that. And there's different ways to do this. And banks are not really a great option. Banks don't have those kind of resources. Banks at the higher levels, what they do is they orchestrate ways to get capital, but they generally don't lend out their own capital themselves because they don't have those sorts of resources. So a big, bank, Goldman or somebody would maybe organize a stock sale and take the company public. So they'll do an initial public offering where they'll put those shares out there on the market and see what the investors think they're worth. And when they sell a share of a company, they actually sell a chunk of the company. So if there's 1 million shares outstanding and you own a share of that company, you own 1/1,000,000th of that company. You've got an equity position. So if the company goes out of business, you've got nothing. That was your company that went out of business. They don't owe you anything because that company doesn't exist anymore. So, it's maybe a little bit more risky than them owing you money because they don't owe you anything. Pardon me. You own the company, so you're not entitled to anything else. If a company wanted to get larger but wanted to use borrowed money, they didn't want to dilute their ownership, they didn't want to sell a portion of their company, they could get what they call just a commercial bond. So again, the big banks would be involved in this, and you as an investor could put up some money, say 20 grand, and that money would be lent to that corporation and then paid back with interest. And you don't own any portion of that company. And if that company goes out of business, well, that corporation still owes you the money, so you can get in line with the rest of the people who are the creditors and try and reclaim some of that money. But you're in a different position. You're a bondholder. You don't have voting rights. You're not part of the company, and so it's just a different thing. So you'll hear about stocks and bonds. Bonds are an equity position. Stocks are an equity position. Bonds are just basically a loan position. So I'm not a huge fan of bonds. I don't own many bonds, but sometimes they can be good investments. But we'll talk about bonds in the different sections. Primary and secondary markets. So if you want to buy some stock, let's say you want to buy stock in Ford Motor Company, you perhaps, if you're maybe an employee of Ford or you go through the corporate relations, you could maybe buy Ford stock directly from Ford, but that's not the common way it's done. What you would typically do is you would go, through your broker and you'd put in an order for Ford stock and you would buy stock that's already out there. It's on the secondary market. It's not the original stock. It's not like buying a used car. It doesn't depreciate or anything. It's the same as buying the stock from the company, but it's just the stock has already been issued. So that's what they're talking about there. Now, there is a situation where there's an IPO, initial public offering, but this is more of a crapshoot because what happens in an IPO, Facebook, whatever. Good thing they're not doing an IPO now. I don't think they have the potential that people thought they had at one point. But anyway, when they come out, go public, the accountants, the advisors, whatever, they come up with some theoretical stock price that they think the company's worth, and they put it out there, and then the market very quickly starts buying these shares either at that price or at a discount, or they don't sell, and so it's just kind of a gamble, that initial stock price, because the market really hasn't had a say at that point. The market will establish what the price is, but they'll put out their initial public offering, and they'll say it's worth $25 a share, and is it? Who knows? The market hasn't voiced an opinion yet. Typically, though, IPOs are financially advantageous for those who can get in on them, but it's not a corrupt game. But you might need connections. You might need to be a preferential customer to even get in on the IPO on some of these companies. By the time you are able to purchase the stock, it may already be in the secondary market. So anyway, IPOs are a unique thing, and then secondary market where stocks are traded. So yeah, 99% of everything has to do with the secondary market. I used to buy some. I worked for a company called Booz Allen, just a soul crushing firm. But anyway, I worked for those guys, and they had a deal where I could buy stock from them at a discount, 5% discount, and so why not? I didn't really like the company, and so what I'd do is I would buy the stock at a 5% discount, and it'd accumulate. They'd take it out of my check every month, and then quarterly, I could sell that stock if I wanted to. They'd transfer it into my account. I could do whatever I wanted with it, and I would sell it that day. So in my mind, I was just whatever. The stock price might change a little bit, but my main goal was just to sell it for the market price, which, since I bought it at 5% less than the market price, if the stock was flat, I still made 5%. So for me, it was a way to essentially make an extra $700 a year by no work other than transferring some money around. So anyway, if a company has that opportunity, the other thing, the smart thing about selling that stock is you'll see people who, gets more like old school type situation that may not exist anymore, but let's say somebody works for General Motors. They work for General Motors their entire life. They have a pension with General Motors, and now they're doing the employee stock purchase program, and they have a bunch of General Motors stock. They've got everything in one basket. If General Motors tanks, their pension goes away, or maybe some portion of it. Their stock portfolio is crushed. So it's not smart to have everything aligned with a single entity. So even in that case, I would still have my sort of program that was, fairly mercenary, but that's what made sense, was to get the stock and sell it. And I don't know, I did it for longer. I worked there longer than I thought I would, but I was probably there 10, 11 years, and made an extra $700 a month. Or $700 a year, sorry. Not big money, but enough. There were limits on how much they'd let you purchase, and I took it up to the limit. Types of investors. So, big picture, you are a retail investor that they don't necessarily, they're call them individual investors, but institutional investors, big, the PFD people, the people who run the Alaska Permanent Fund, did I say PDF? PFD? No, PFD, I got it right. Teachers' unions, big pension funds, state pension funds, and other huge, maybe insurance companies who have those insurance money that they're investing. Then you have portfolio managers. You have the big mutual fund companies that have got these huge, stock portfolios. So these people have some swing. They've got some power. And then you get down into retail investors who proportionally are pretty small. I've got shares in whatever company, and it's not like they're calling me up or sending me a thing saying, oh, we have our annual meeting and you're invited. No, it's not a democracy. Your voting rights are tied in the number of shares you've got. So if you've got 30 shares, it may represent whatever financial position. but you get 30 votes. The person with 3 million shares gets 3 million votes. So yeah, there's typically, unless you get together in a huge group, you don't have that much power. Day traders, it's kind of silly to put these guys as a separate category. Day traders is a specific thing, and there's in the market you want markets to be fluid. You don't want, if prices start to drop, you want somebody to jump in there and buy. And day traders are a specific thing that tend to come around when the market is super volatile and going in an upward direction. And so you get all these people who think they can make tons and tons of money by watching the charts and making all these little micro trades, and they'll jump in in the morning and they'll jump out in the afternoon, and they're anyway, a lot of times they provide a function in terms of providing liquidity to the market, but most of the time these guys end up losing money. But they're a specific group, and yeah, they generate a lot of taxable income, and generally go away when the markets get sour. So anyway, institutional, portfolio, and individual investors are really the main classes. So bonds, talked about bonds. So they're a long-term debt security, as I said, a loan. Government agencies, very common. Obviously, you can't buy stock in whatever municipality. You can't sell, well, unless you're, I don't think we've quite got to that point, but you're definitely in the third world realm when you're selling chunks of the government to private individuals. Corporations, though, corporate bonds, they're taking loans on behest of corporations. So corporations have the option of selling stocks or bonds. Government agencies, they can only go the way of bonds. And sometimes they can do, tax incentivized bonds, municipal bonds perhaps, sold by a municipality, that if you buy this bond, we've made an arrangement where it won't be taxed. So we can offer a lower yield, but your return is higher because your return is not taxed, because we're the government and we can make those sort of deals. Mutual funds, there's lots of reasons that stocks are a great investment in terms of we can look at the statistical data, and really from the turn of last century, the yields were about 10% per year. So a 10% annualized yield, that's pretty high, pretty significant. But the risk is a bit higher because you're invested in individual companies. So a way around that is to perhaps be in a mutual fund. In a mutual fund, what you do there, we'll spend some time on this, but you get a bunch of stocks or a bunch of whatever, but it can be comprised of whatever the portfolio manager wants to put in there, but a bunch of different stocks, and you put them in a portfolio, and then you consolidate them and you sell them for a single share price. So let's say you're expecting the tech sector to go up, but to pick an individual company, let's say like NVIDIA, the graphics card people that also they do a lot of Bitcoin mining processing type stuff. You expect the tech sector and the Bitcoin mining to go up, and those processors are going to be needed. So you decide to invest in NVIDIA, and it's a little riskier because you're in just a single company. You could be right about the tech sector going up, but you could be wrong about NVIDIA being the company to lead it. So a little safer bet might be to form a mutual fund or invest in a mutual fund that's investing in that sector. So you get a mutual fund that's comprised of whatever, AMD, Intel, NVIDIA, and a bunch of other companies. And now you don't necessarily have to be right in terms of picking the individual company. All you have to be right is about that sector. And so that's a little bit better. And then also, since it's a mutual fund, it used to be more difficult to buy stocks, individual stocks. Now it's quite a bit easier because of automation and all the rest of it. But anyway, mutual funds have always been super user friendly. You know, you don't have to buy in even shares, and you don't have all these other restrictions that you used to have in the market. Now you can buy fractional shares, you can do all that kind of stuff, and the brokerages are dead easy. The commissions are low or non-existent. So the usability features that made mutual funds better have kind of been eroded. Not because mutual funds have gotten harder, but because the other investments have gotten easier to orchestrate. But mutual fund, and they could be comprised of anything. You could say, you know, I traveled to Vietnam and I don't know anything about Vietnam. I don't want to get involved in the currency exchange, but I do want to invest in some Vietnamese companies. You can find a mutual fund out there that concentrates on Vietnam or the Pacific Rim or whatever, and you can invest there. And you've got some portfolio manager who hopefully is the smart guy who does have all that knowledge and can get through all this and not expose you to a whole bunch of, you know, stuff by you investing in a foreign company. And they can figure all that out. They can go with, you know, companies that are listed on U.S. exchanges, and you can still have a piece of that investment without the complexity. So, kind of cool. Yeah, they're big on spiders. Real estate, obviously, you know, as opposed to just looking at a balance on a sheet, you can actually invest in real estate. And I've talked about before about using borrowed money, you know, margin is what they call it in investing. When you're using borrowed money for investing, that's not necessarily a smart thing to do in terms of the stock market. It can be done, but you're getting into speculation. In real estate, using borrowed money is the way it is done. And even though the yields, the percent of increase year over year in real estate is not what the stock market's getting, if you're controlling more money through financing, maybe you're getting that same yield. So anyway, more hands-on, you know, toilets and stuff like that, or maybe it's raw land, but there's no income property. So there's all sorts of different ways to do this, but real estate is a good investment. And you can always have a blend. What I've tried to do, and it's actually sort of worked out, was to make money in the stock market and then put it into real estate to sort of secure it and a little bit more stable. So because they started out that whole discussion with preferred versus common stock, I had to jump in through, you know, dividends and price appreciation. So dividends are the distribution of the profits. Price appreciation is the actual stock price going up. So again, dividends can either be reinvested by the company, you know, in terms of growth, or they can be sent out to the shareholders. Price appreciation, you know, just pure capital gain. Buy the stock for 30, sell it for 35. So growth stocks, they're growing. They're dumping those profits back into growth. Income stocks, they're dumping that income back to the shareholders. Bonds, they pay you basically your, you know, when you think about borrowing money, you know, you think about renting money, and you've given this municipality or this corporation money, and they're paying you rent for it. So they're paying you an interest, a coupon payment. And then can be some bond appreciation. If you happen to get a bond that's paying, say, an 8% yield, and then because the market, the bonds will sell for what they need to. You know, if a company is selling a bond, they'll sell it at the price that people will buy it. You know, if you're selling a bond with only a 6% yield and somebody else is selling a bond with an 8% yield, well, nobody's going to buy your crappy 6% yield. They're going to go after the 8%. So the people selling the bonds, they'll set that interest rate, the yield rate, at the price they need to get somebody to purchase it. And let's say, you know, at the time, interest rates are high, and so they have to sell this bond at 8%. Well, say a year from now, the markets, the interest rates have stabilized, gone down, and now new bonds are only having to be sold at 6%. Your 8% bond it looks pretty good. So somebody, if you go to sell that bond that's yielding 8%, you can sell that before it hits maturity, and the person buying it's going to have to pay a premium for that because it's a better bond than what's currently being offered. So that's where the way a bond works is you give them the money. You give them $20,000 and they pay you 8% yield every year for 20 years, and at the end of 20 years they give you your 20 grand back, and everybody's happy. If you want to sell it beforehand, you don't want to keep it all 20 years, you can sell it in the secondary market. And that amount that you're going to get for it, if it's at 8% yield and the current yield on new bonds is only 6%, well, they may pay you $22,000 for that $20,000 bond because it's going to be worth more based upon that those payments that are being made each year. But conversely, if things go to whatever, and now all of a sudden new bonds are being issued and they're paying 10%, and yours is only 8%, yeah, your bond is only worth 16, 18,000, something like that. So the price of your bond in the secondary market can change. Mutual funds are it's the underlying equities. Whatever happened with the stocks, underneath them. And then real estate, rental income if it's a rental property, or price appreciation. So if it's raw land, it's purely price appreciation. If there's a house on it, there's some income, probably some depreciation and other factors that go into that. We don't need a whole bunch of formulas. We can kind of figure that out in our head. You're not going to have this on a test or something, but they're trying to make this more complex than it needs to be. But all they're really saying is, buy high, sell low. What did you sell it for? What did you purchase it for? That's how much you got. That was your return. And oh, by the way, if you got some rental payments in there, calculate that. Here's the bond thing, same thing. So again, don't get wrapped up with the formulas. They're trying to make things more complex than they need to be. We will not have formulas on the test. Differing tax rates on returns. So interest payments, taxes on your income, so a short-term rate. And here we go with, again, another short-term gain and then a long-term gain because it's held over a year. So it makes a huge difference on your overall yield depending on what you're taxed at. Risks from investing. So there's all sorts of risks, but what you need to make sure, risk is not a bad thing. Risk is the only way you get a return. Now, you can have high risk with low return, and that's what you want to avoid. That means that, that's not a company worth investing in. And it sort of gets back to this, preferred versus common stock. Oh, I want to buy this stock because I'll get preferred stock, and if the company's not doing well, I'll still get a dividend. Well, I don't want a company that's not doing well. I don't want a company that's a company I probably need to prune out of my portfolio and move on. So small firms, risk versus return. Bonds are kind of funny. It's extreme grade inflation. They have AAAs. I mean, it's like getting a AAA on a paper or something. In the bond world, the AAA all in caps. And when you get down to, B-rated bonds, which are acceptable in an academic environment, now you're starting to get into, not junk, but you're starting to get into bonds that have some questionable stuff. You wouldn't buy typically a B-rated bond And then, you know, at lower stuff, you get into junk bonds. Or if they're selling them to you, they'll call them high yield bonds. Well, yeah, high risk and junk are the same term. The reason they're paying such a high yield is because they have to. There's so much risk involved. Risk and return in mutual funds has to do with the underlying stocks. But the diversification you establish by having mutual, many investments rather than just an individual stock is huge. So, yeah. Property values could decline comparing different. But the thing with real estate is you can kind of reach out there and touch it. And real estate doesn't go out of business. You can lose it all with the stock. The company goes bankrupt and it goes to zero. Real estate might decline, but if it declines by 5%, it's like a national crisis. Stock market, that's just good old volatility. So yeah, borrowing to invest, so using margin, taking risks to recover losses. This is all like a bad casino scenario. Doubling up to make up. And going to the ATM to put more money on the table. When you're losing, just stop. And don't be, Okay, so the term project. A lot of people have been asking me about this. Some of the questions that come through so far had to do with, I'm not, in a typical scenario, and I've already, established working. Fair enough. So, establish the main part of this term paper is to make a product that's useful to you. So tailor it to however is most useful to you. And if you're, involved in your career in the middle of it, then do it based upon your current circumstances. Now, again, I don't want your own personal data in the paper. It could be a person that's very similar to you in terms of profile, demographics, the rest of it, to make it useful for you. But you don't have to tell me how much specifically you make or any of that stuff. I don't want those details, and I, obviously I can't keep any of that stuff confidential, and there's no need for precise data like that. Just make the paper useful to you. And then other people are like, well, I'm still in college. I have no clue. I don't know whether I'll be married. I don't know what I'm going to do. That's where you just kind of got a forecast. And so I came up with a thing of about 5 years, out. But anyway, just fast forward yourself to a point in life where I do have a job now, and this is what again, it's a plan. Everything in personal finance is a plan. The chance that plan's actually going to be executed the way you think it is quite remote. But at least you've got a plan to modify from. You're not, starting out with nothing. So anyway, all these other things in terms of students, saving for college, life insurance, things that we've been talking about. We'll go back over it, but 401ks, tax deferred compensation, thrift savings plan for some people. But anyway, all you need is sort of a checklist of how you're going to accomplish things, and then obviously you're not going to hand in a checklist. You're going to hand in a term paper that's 4 to 5 pages, so it's a narrative that explains how you're going to get through this checklist, basically. And don't make it useful, but a lot of people don't like it because they don't like the freedom I'm kind of giving you to tailor the plan to your own needs. But that's what I am giving you. So there we go. All right, that'll do it for today.
Which will be celebrating with Dane Kelly of the Crushed Grapes around the fire pit, and plenty of Austin Hope and other California Reds. Stay safe, keep up the great work, keeping us sane. Go podcasting. Go podcasting! P.S. I've been listening since